Thought we'd take a look at one of the big players in the property mix, Domain. Always the bridesmaid to realestate.com. The company declaring a final dividend of 4 cents. It's first since 2019. Revenue, earnings, profit all climbed through the full year as the property market found its feet. Net profit climbing by 2/3 to around $34 million. The company's chief executive, Jason Pellegrino, saying the recovery in market listings has combined with an expansion in Domain's controllable yield to deliver accelerating revenue growth in the second half. And does it make it look any more attractive, an investment at this level?
No, it doesn't look any more attractive at all. It's the problem Domain has is that they came into the market where you have a dominant player, which is REA, realestate.com. Realestate.com is 10 times bigger than Domain, and no matter what Domain's done as far as spending a fortune on marketing with Fairfax and so on, they've never really, I don't think, been able to make any serious inroads on REA. And if you look at their numbers, they've only been listed for 3 years, so it's not enough history for us anyway, but their return on equity is only 1.7%, which is pretty woeful, and it's on a PE of 116. REA is on a PE of 61, which is also really expensive, but Domain's on twice, you're paying twice the rate for the same dollar of earnings in Domain, and it's a far inferior business, in my view, than REA is. So I wouldn't consider Domain. I'd buy REA, but it's not at 61 PE.
Yeah. That's really out of whack, isn't it? Scott, what do you think of the result and Domain?
Yeah, I'm glad you asked the question that way, Koshy, because they really are two separate answers, quite honestly. The first is, what do you think of the result? This is a really, really good result. It's hard to see it as anything other. 10% growth in revenue, 20% growth in profit. Not much more you can ask of a company, particularly in over the last 12 or 18 months. Now, to be fair, house prices didn't fall as much as might have been the case. Unemployment didn't rise as much as might have been the case. So it's hardly been the worst situation, the worst conditions for housing. But continued growth there, top and bottom line, ticks all the boxes. Have done exactly what they should be trying to do. That is get good top line growth and convert that to even better bottom line growth. So I can't complain about the result at all. I share Mark's concerns. I do like REA more than Domain. I don't dislike Domain as much as some might. Most of these network effect businesses, think about the Facebooks, think about the Seeks, are mostly winner takes all or winner takes most, because you don't everyone's going to go to one place. And basically, if you're looking for a job, you got to go to Seek. If you're looking to hire someone, you got to go to Seek. Pretty straightforward. The difference here, of course, is that the cost of the classified is a tiny, tiny, tiny fraction of the price of the house you're either looking to buy or sell. If you're a seller, you're probably not going to say, well, REA is bigger, I'll just do that one. Almost everybody, particularly if you live in a what was Fairfax newspapers, state or city, you're going to say, well, look, REA is bigger, but a lot of people use Domain as well. Why would I not use both? And so I'm not convinced it's a losing proposition as a business. To Mark's point, 60 times earnings, even with the sort of growth it delivered. Look, if it can do 20% for the next 10 years, it's probably cheap. But can it really do 20% for the next 10 years? I'd be very, very surprised. So, look, it's one you'd happily say, look, doing really well, fine result. I'd happily buy the business at the right price. I have nothing against the business itself. But I do think it's way overpriced for what you're getting.
Yeah. On those multiples, it certainly is.